open the floor up to you guys to ask us any questions. We realise there might be quite a few questions on what the new rules mean to you in particular, so we want to try and make it as useful as possible in that way. So I'm Sean Hankin. I'm Head of Forensic Investigations and Intelligence at the SRA. And this is Jatinder Loyal, who's a Policy Associate, again with the SRA. And for our sins, we have been authors of the new accounts rules, so we can't pass the book if there are any issues that you've got with it. So we'll just start with a quick recap on where we've come from. The new accounts rules, which will be the SRA accounts rules 2019, is the third phase of a three-phase approach that we've gone through. The first phase was back in 2014 when Brexit was a thing of the future. It was, at that point, what we did was we took firms who only dealt with legal aid money out of the need to deal with that through client account. And we also changed the rules so that it was only qualified accountants' reports that were sent in to us at the SRA. The second phase, that came in with year ends from 1st of November 2015. And at that point, we expanded the exemption for firms who needed to have an accountant's report. So you'll see the exemption criteria is replicated in the new rules. So firms who hold less than £250,000 and an average balance of less than £10,000 no longer need to have an accountant's report. And we also removed further the need for well, the other main thing was, the accountants' reports themselves. So we asked the accountants to start looking on a more risk-based. We took away the checklist, less prescriptive, and we asked accountants to look at the type of firms and the type of work that those firms did. The third phase will be covered really by Jatinder in the new rules, and we'll, as I say, we'll spend a lot of the time in the Q&As, no doubt, looking at those new rules. So myself as head of the investigations teams, just a quick recap on what we're seeing out on the ground and what we're seeing in the qualified accountants reports that are coming through as well, because we review every single qualified accountants report that comes into the SRA. So three main issues really that we're seeing on the ground. First is around reconciliations. Second is around residual balances. And the third is around Rule 14.5 as is now, which is use of client account as a banking facility. So taking each in turn, the reconciliations, what we're seeing is that people aren't doing these properly. So they're not the three-way reconciliations. They're not being signed off by a partner. We're not always seeing adjustments that are identified in the reconciliation being actioned the following month. So what we're really recommending there is that you as solicitors take more responsibility, I guess, when you are signing off reconciliations, to make sure that they're getting to you on time, that you are looking at all the adjusting items, that they make sense to you, and that you're actioning anything to make sure it doesn't recur the following month. In terms of old balances, I already had a few questions out on the stand about how you deal with those. The main thing is that when we're seeing on the accountants' reports, people are getting qualifications, it's because they're not actioning those residual balances quickly enough. So we understand that a lot of firms will have residual balances, and that's inevitable if you hold client money to a large extent. But the best thing that you can do is have good file closure procedures, so accounts are zeroed out before you go to archive. That if there is an issue, you make sure you quantify it, you see what clients those balances relate to, and you try and deal with them in accordance with the guidance and the rules that we have. So there's different rules for whether it's under 500 or over 500 pounds. And again, if you can demonstrate progress and that you're taking those matters seriously, then that's something that's far less likely for us to be concerned about. And finally, from me, the Rule 14.5 issue, no doubt you'll have questions. All these things, all these three things are part of the new rules as well, so they're all prescriptive parts of the new rules. We know that you want to try and please your clients, act on their instructions, but you've just got to think whether the payment that you're making is part of the underlying legal transaction. Do you need to make that payment out to a third party who's unconnected with the transaction? So what we'd ask is you step back and think about whether that payment relates to your role as a solicitor in that particular transaction. Okay. Over to Chinda.
Thank you to Sean. So I'll give you an update on where we are with the new accounts rules that come in force on the 25th of November as part of the SRA standards and regulations. So we consulted on the new accounts rules back in 2016. I have to say that, as Sean mentioned, that we're contributors with our head of legal policy on the new accounts rules. For me, being with the SRA now for 16 years, it was one of the most open consultations in the sense that we did look at everything that we could do to inform our proposals. And the first proposals that we consulted on was the revised definition of client money. And there was a rule, and it was going to be a rule that any fees or disbursements that the firm had received would have to be paid. It's as loud as the mic will go. I am, okay. So there was a rule. We proposed a rule which was that any monies that the firm received that was money for fees or disbursements would have to be ring-fenced and held in the firm's business account. The implications of that, or should we say the impact and the responses we got, was that the impact on law firms would be so great in terms of things like VAT, not just that it wouldn't be able to be used because it would have to be ring-fenced until the client matter had completed. So the new rules are much more flexible because we've listened to what people have said. So the definition of client money is not dissimilar to as it is now. So all money that you receive from a client or handle on behalf of a client will be deemed to be client money. What we've introduced in the definition of client money, though, is an exemption for firms that if they only hold money for their fees and disbursements for which the firm's liable for, so it might be council's fees or other expert fees where it's you as the law firm, you as the solicitor are liable to pay, then you can rely on the exemption and hold that money in your business account. What this means, though, because it's an exemption, you can't be operating a client account and be exempt at the same time. It makes no sense. So if you are operating a client account, then all money that you receive for fees and disbursements which relate to that transaction have to be held in your client account as they are now. The purpose of the exemption is to give those firms the flexibility and a solution, which means that they don't then have to comply with the other rules in the accounts rules around record keeping or having to have a accountant's report done on money that's being held in the business account. The rules go further then in terms of looking at, they reconfirm the core principles that client money has to be kept safe. It's also reconfirmed, or should we say, affirmed in the code of conduct as well for solicitors and firms that any client money has to be held securely and safely. The rules go further and they confirm that the only money can be withdrawn from a client account on the client's consent. So again, making sure that it's on client's instructions and that the money isn't being used where we see, and Sean will hopefully confirm, where Peter is used to pay Paul, money that's being held for Peter is used to pay fees that are, or should we say money that's due on Paul's matter. So that's something that we've confirmed as well. The rules also confirm that a client account can't be used as a banking facility. So the current 14.5 is in the new rules as well as 3.3. That's again because it's a priority risk for us as an organisation. We're still seeing loads of law firms using their client accounts as banking facilities. We did update the warning notice last year in August and provided some real-time, real-life case studies as well to say that, yeah, these are the sort of examples that we're seeing, these are the concerns that we have. But we also set out, which we thought and we think is quite helpful, and the feedback that we had is that it is helpful to have case studies which set out where we think that it wouldn't be a breach of 14.5 as well. So that will apply going forward as well. The rules then go on in terms of confirming that records and reconciliations need to be carried out. So records need to be kept on a client account and also reconciliations need to be carried out as they are now. The rules do introduce something which the current rules don't do, which is setting our expectations in terms of a third-party managed account. So that's an alternative to firms wanting to hold money in their client account. Now, this is something that, should we say, a lot of new firms will be thinking about if they're not sure about what the cost of running a client account involves or how to do it. It might be that this is the solution for them. For existing firms, it might be that they want to remove the risk of having a client account attached to them and think about using a TPMA. The TPMA is a solution whereby the provider, the TPMA provider, is waiting for an authentication from both the firm and the client to confirm that monies can be moved. So the client's actually involved in the transaction themselves. So it's been held outside the firm's client account. It's something that's been operated quite separately. But what we've done in our rules is confirm that this is allowed, because there's a misnomer. Firms are thinking they can't do this because our rules don't say anything, which is why we issued the guidance in December 17 to say no, firms can use a TPMA as an alternative to operating a client account. But the rules now confirm that it provides the facility but also sets out the parameters. So the provider has to be an FCA authorised and regulated provider, and they comply with the payment services regulations. What we then have to think about then is the rules then go on further, like I said, in terms of the record keeping and the need to get a reporting accountant to come in and do your annual checks or as and when they're needed. That is something that will continue under the new rules. Something that has changed, though, is that it will be our decision to request for a final report. So when a firm is closing down or stops holding client money, it will be our decision to request a report. At the moment, it's done as part and parcel of the closure process. So when a firm is ceasing to be an authorised body, we then ask for a report as a matter of course. What we'll do now is use the closure notification and the information that we get from the practitioners at that point in time to establish whether there is then a need for an independent report to be obtained, because there might be certain risks. So in a nutshell, that's the new rules and how they look and feel. They are shorter, they're simpler to understand. What we don't want to introduce is complexities, and what the rules have taken out is the prescriptive timetables that are there at the moment. So we have the 14-day rule and the 2-day rule. A lot of firms, unfortunately, fall foul of the current 17.3 because there's been a day's delay in transferring the firm's money into the firm's account from the current client account. You know, that's quite unfair in the sense that if you're a small firm and the way you bank is that you bank every Friday or every 2 weeks, we shouldn't be penalising you for a delay in moving your office monies from the client account. What we would be concerned with, though, because the term now is that you move monies promptly into the right account. So if you receive monies into your office account, which is client money, it needs to be moved promptly and vice versa. Is that we would be worried, say, for instance, if a firm was holding their office money in the client account for an unnecessary period of time, probably because they obtain a better rate of interest on their client account. But if that's the only way the firm is surviving, then that calls into question the firm's viability as a firm. So that would be a risk for us that we'd have to try and manage, because if that interest was taken away for whatever reason, if there was a decrease in the interest rate that the bank was offering, it would then have an impact on the firm's viability going forward. So that's a massive risk for us that we'd be concerned with. So the term promptly is making sure that firms are actually looking at how they're managing their business effectively, but also looking at the firm code of conduct, which sets out the requirements in terms of how you manage your business, and making sure that it's not just viable as a business, but you're protecting client assets and money throughout. In terms of, like I said, TPMA, it is there as an option for firms to think about. Something that's key is that you can use this in conjunction with your client account. We do have some providers here today, and I think they were here yesterday as well, where they're talking about the solution that they can offer. People have said to us, law firms are saying, we don't know who the providers are. It's not something that we can publish, so we're asking the providers, just as banks, just as indemnity insurers have their own marketing tools and marketing facilities for the TPMA providers to get in touch with you as law firms and talk about the solution that they offer. There are some benefits to a TPMA. One is that you are not exposed or not as exposed to the risk of a cyber attack. If someone attacks you, infiltrates your bank details or bank account, and they see that there is no money or there's only a very small amount of money being held, they're more likely to walk away rather than take the money that's sitting in your client account. With a TPMA, they're not going to know who your provider is. They won't know which account it's with. It's confidential. It's not something that we will publish either. So it is confidential. So in terms of cyber attacks, the risk is mitigated. It's not removed, but it's mitigated. We're also trying to work with insurers as well, because a breach of the accounts rules falls within the definition of claim on the professional indemnity side of things. So automatically, as soon as there's a breach, it doesn't matter how serious or minor the breach is, it automatically results in a claim on your indemnity insurance. That will then bump up premiums. If you're subject to a breach of the accounts rules because you hold client money or you operate a client account, TPMA is another solution in those circumstances, and that's what we want insurers to start thinking about, is that if the firm is not holding or operating a client account and they are holding money through a TPMA, then what they've done is remove the risk from them as a law firm. Okay, the risk has been passed on, but it's them as a law firm that are not exposed to that risk anymore. So that's where we are with the new rules. In terms of guidance, what we don't want to do is pull out the current rules that are not in the new rules and put them into guidance, because that's not going to be helpful for anybody. So what we're doing is looking at a suite of guidance which is relevant and helps you as practitioners understand what we expect. So it's providing case examples or solutions in terms of, this is what the rule says, and this is how we think you can achieve compliance with those rules. But like I said, it's going to be not a whole suite of guidance. So don't expect, just because we've got, 52 rules at the moment and only 11 going forward, that there's going to be 40 pieces of guidance. No, there won't be 40 pieces of guidance. We'll look at the key risks and the key areas where people do need support from us. So it will be on things like banking facilities, which is something that we'll update, but also in terms of the records and systems. Again, a lot of people fall foul, as Sean mentioned. It's the biggest area where we see reports being qualified. Again, there are providers here today that are helping firms think about solutions in terms of how you manage your money and solutions, technological solutions and case management systems. So do get in touch with them, because it does help you. So we'll be providing guidance in terms of what good looks like. So that's where we are. We'll open up to questions, but like I said, think about solutions. The thing about introducing, should we say, or publishing the rules now and then being introduced in November is that it gives people time to start planning. I see it as a time to do a sort of MOT for yourselves on how you're managing your client money and the client account. So it's thinking about, okay, what do I need to do going forward? You've got 6 months to prepare. So we'll open the floor to questions. We have had some questions in as well, because there's a few people that couldn't make it, so they've sent questions through. So we'll air those with you as well. But we'll open the floor to questions.
Can you operate a client account and a third-party managed account? Because if the third-party managed account isn't client account, you're not providing a banking facility for your client if you use the third-party managed account. So you could hold a rent deposit in it, for example.
Again, so the question is that can you use a TPMA together with your current operations, i.e. a client account, and through the TPMA can you provide a banking facility, i.e. hold rent deposits through that? The TPMA should be used only for transactional purposes, and this is again something that TPMA providers are looking at, which is that they don't want to be exposed to that risk of providing a banking facility through the solution that they're providing. Again, they're going to be FCA regulated. If that person is then providing something through that TPMA, which is something that's nothing to do with a transaction, again, it's something that will be reported to us, and we'll take it then as an issue. It might not be a breach of 14.5, but then it goes to the integrity of the firm in sense of how are they actually providing any legal services to the client, or are they just doing stuff for the client's convenience? So yeah, primarily not a breach of the 14.5 if you use a TPMA, but if it's reported to us that the TPMA is being used as a facility to get round a mischief, then that's something that will be reported to us. Sorry, we've got another question at the back. That was just to confirm. So that was Jeff from ShieldPay, one of the TPMA providers here today, that are saying that the TPMA account or facility shouldn't be used to hold rent deposits, but it's thinking about a typical or current escrow accounts that do exist, which are a facility between client and somebody else, which provides for that money to be held for a specific purpose. So again, it's not saying that you're avoiding a breach of or evading a breach of Rule 14.5, but there are other solutions which mean that you remain compliant as a law firm. We have a question at the back. Ross, do you mind shouting?
So that was a question about the new rules and how they no longer mention the £500 and how the process in terms of paying that to charity and what have you. So this is one of the things that Jatinder just touched on, is that we will provide guidance in this area. We realise that all firms have this issue from time to time if you hold client money. So the guidance will I think as things stand, we've got it in draft, haven't we? It does reflect the current position in that what you do now with the amounts under 500 will be replicated in the new guidance and the amounts over 500. So just to clarify what it is, you've got those processes to go through and try and trace your clients. You need to be proportionate in what you do and how you do it. If you can't ultimately trace your clients, then you can make payments to charity and get an indemnity for those payments in case the client does materialize in the future. And amounts over £500, then our ethics guidance team can grant waivers in terms of those amounts, and they're very prepared to work with you in terms of doing that.
I was just going to, add to that, Sean, which is that hopefully, again, the use of a TPMA is a really good solution to residual balances as well, because the money is moving very, very quickly, in the sense that because the client will see transaction, they'll have access to this portal. They'll see the money's coming in and out. So if a client sees that they're due £500 at the end of a matter, the TPMA solution provides the client with that alert immediately to say, you are due some monies back, or you should be asking for your monies back. So again, the TPMA, like I said, it's not to be seen as that, client accounts are being wiped away completely. What this does is provides a really good solution to some of the issues that we are seeing. So like I said, there are providers here today. I think we have ShieldPay, and like I said, we mentioned Third Fort as well, that are here today. So do go and speak to them. There are other providers out there as well that are thinking of developing. Some banks that you bank with at the moment are also thinking of developing products. So it's a market that will develop slowly. That's something that we are looking at. So the rule does say at the moment that where you operate a client's own account, so it might be where you're appointed as a deputy or trustee, so you're managing the client's own personal account and their affairs through that. The rule, the way it's been drafted at the moment, means that you have to get reconciliations, and not just reconciliations, it's managed just as you are managing your own client account. It's something that Sean and I do need to look at very, very carefully in terms of the mischief that we're trying to address here, which is that it's still client money. It doesn't matter where it's held, whether it's within the law firm's control or the client's own personal account. What we want to make sure is that it's not being used for any alternative purpose. It should only be used for that client's matter. But in terms of the obligations that we're putting on firms in terms of the reporting requirements and getting regular statements and reconciliations, that is something that we do need to look at in terms of, is the rule then impacting firms unnecessarily if they aren't able to obtain, should we say, 5 weekly statements or provide reconciliations every month for whatever reason. Again, it's because client accounts are very different. It might be a normal bank account, it could be an ISA, or it could be some other investment scheme where the client is actually holding their money. So it's something that Sean and I are aware of, and it's something that we will pick up either through guidance or a Q&A for firms.
It's just worth adding to that. These sessions, and we've met with people like ILFM and ICAEW, these are really useful to us because we've got a window now until 25th of November for us to get everything together and bring out FAQs and clarify our guidance to make sure that we do cover everything off, and that when it is rolled out, it'll hopefully be very smooth when it does. Another question? Yeah, so I think it's really good that we've got these guys here today. Do go and speak to them. It's a new area. When we first introduced the idea of firms being able to have TPMAs, there was Barco was the only provider, and that wasn't suitable for most of the transactions that firms would undertake. So as it's now enshrined in the rules, you can do it now without any waivers or anything. The market's developing, so we are encouraging this. We realize it does reduce your risk. It's the biggest risk area that we've got around holding client money. So it might well be that the products these guys have got or develop in the future will be suitable for you. Any others? No. We realize, most firms will still carry holding client money. What we tried to, with the new rules, make it so there's not a big change on 25th of November. If you carry on doing what you're doing now, you'll most likely be compliant with the new rules. We've just taken that prescription away, but no, we're not. They put me out of a job anyway if I did that. So.
Just on that, even though we're not prescribing it, what it means though is that because it provides a solution, so you need to look at it in terms of how it interacts with the other reforms that have been made. So where solicitors can now act on their own or provide services through their own as a freelancer, there are conditions, i.e. that they can't hold client money. That's one of the conditions of being of a freelance solicitor. The benefits of a freelance solicitor have already been discussed in sessions that were held yesterday, but they are there in terms of people that have had a career break and think of coming back, but they only want to do it as a freelancer. What the TPMA solution provides is for them, because they haven't got a firm through which they trade and which is authorised by us, they can still actually help the client through a transaction by having a TPMA. So even though we're not saying it's a rule, but what it is a solution that fits in with all the other reforms that we're working on as well. I think we're done. Like I said, some of the questions that we had sent through to us have already been covered off. Sorry, there's one more question.
To get an exemption for the accountants.
So the question was, is there an exemption, a formal exemption, in order to get a process in terms of getting the need to get an accountant's report? Sean's already mentioned those were changes that were already introduced in the rules in 2015. So the exemptions already sets out that if you hold no more than 250,000 in your accounting period, you don't need to get an accountant's report. So it's already within the rule. There is no process. You don't have to seek authorization from us to rely on the exemption. So that's already there within the rules. If you don't hold more than 250,000 in your accounting period, the rule's already there, which provides that facility.
So yeah, that's right. Just to add to that, like I say, you don't need to apply to us. All I'd say is you just document what your balances were at various points during the year. So use your reconciliation point. So if you're holding less than £10,000 and it never goes above £250,000, and you can document that, you can point to those bank statements or reconciliations. That's all you need to do, and then you don't need to get the accountant. You don't need to tell us, and you're out of the system and the need to do that. And it's against trying to reduce the regulatory burden, because there's a big cost, isn't there, to having your accountants in every year. So hopefully we can get costs down and then pass that on to the clients and try and be more competitive.
So we remember things as we go through. So just as Sean said that you can rely on the exemption, what the new rules do actually introduce gives us the power to ask for a report. So even if the firm relies on the exemption not to have a report, if we receive information which suggests that the client account is being used as a banking facility, or there is some money that's going missing, so there's no audit that's been done on an annual basis, we can then, under the new rules, ask for a report because we've received information which suggests that there's issues with the client account. So what we'll do then is say to you and give you reasonable notice to say that, yeah, we require you to now go and get a report and deliver it to us. Just also to flag, one thing that the rules also probably don't do is set out terms of engagements in terms of your reporting accountants. Again, that's something that we don't need to do. It's for your accountant to consider how they engage with you, depending on the nature of your work, depending on the nature of the money that you hold and the type of money that you hold, but also the size of your firm as well and the information that they need from you. One thing that's key, though, is that we are highlighting through guidance is that they need to report to us any concerns or any information which suggests that you will terminate your instructions or your retainer with them because they were thinking of issuing a qualified report. That is something that's key. So if Sean's thinking of qualifying a report after he's been to visit me and I say to Sean, you're not my accountant anymore, I'll go and get somebody else, Sean needs to report that to us as a reporting accountant because that would suggest that there's something wrong in the firm. Also, we're pushing reporting accountants to report to us not just evidence or concerns around fraud or dishonesty, but also where there's concerns around someone's fitness to hold client money. So that's not just around, should we say, character and suitability issues, but what we're seeing now, it's common. You know, the number of people that are suffering from mental health issues, people that are suffering from just medical issues, i.e. Alzheimer and things like that, that if a practitioner is practicing where we know that there are concerns around their fitness, just generally to practice, and their ability to hold client money and make the necessary decisions on behalf of a client, that might be the only way that we receive that information. The firm or the solicitor might not have engaged with us, so it might be information that comes to us and then we can work with that firm to make sure that there isn't a continuing risk to clients, and especially client money.
It might be worth just adding on the changes we brought in phase 2 in terms of getting the accountants to use their judgment a lot more and moving away from the checklist approach. We now get far fewer accountants reports in, and those that we do get are far more relevant to us. There's a paper on our website that just gives the statistics behind that, and it's something that we hope will continue, and we're going out and speaking to accountants and trying to answer their questions about when to report and when not to report. But that whole exercise has been really worthwhile in terms of freeing up resources for us to look at what's more relevant and where those big risks are. So in the past, more or less every firm would get a qualified report because of the prescriptive nature of the rules, whereas now there are far fewer, and we hope with when the new accounts rules come in, that will be even less, because we're focusing on those proper risks and the real breaches. Anyone else thought of a question before we finish off? No? Okay, well, let's say we're around, we're on the stand there, so if there's anything you think of or you'd like to talk to us one-on-one, then happy to do that. And thank you very much for all